Electing general corporate tax rates and compliance scenarios for free zone persons. A qualifying free zone person has the option to choose whether to be subject to the general corporate tax rates instead of benefiting from the 0% corporate tax rate typically available to free zone entities. This decision, often based on strategic considerations, affects the taxation approach and eligibility criteria that the free zone person must adhere to. Below is a detailed examination of this election process, potential eligibility impacts, and illustrative examples. 1. Election to be taxed at general corporate tax rates. A qualifying free zone person can make a deliberate election to be taxed under the general corporate tax rate rather than the 0% corporate tax rate available to qualifying free zone persons. This election is not limited to a single tax period but is structured as a multi-period choice with specific implications. Timing of election. The choice can take effect from either the beginning of the tax period in which the election is filed or from the start of the following tax period. This election period extends for a fixed duration of 4 consecutive tax periods. Renewal. At the end of these 4 tax periods, the free zone person can opt to make a similar election again, extending their taxation under the general rates if desired. 2. Impact of non-compliance with qualifying conditions. A free zone person will no longer qualify for the 0% corporate tax rate if it fails to meet any one of the specific qualifying conditions during a tax period. The conditions encompass maintaining adequate substance, compliance with documentation requirements, and ensuring qualifying income thresholds are met, among others. The implications of such non-compliance are as follows. Immediate impact. If any of the qualifying conditions are breached, the free zone person forfeits eligibility for the 0% corporate tax rate starting from the beginning of that tax period. Taxation shift. For the following 5 tax periods, the free zone person will be subject to the general corporate tax rates. This rule ensures that temporary lapses in compliance result in a prolonged ineligibility period to discourage inconsistent adherence to free zone requirements. 3. Implications of election on corporate tax law provisions. Once a free zone person elects to be taxed under the general corporate tax rates, it will no longer be considered a qualifying free zone person as it no longer meets the mandatory conditions for such status. The change in tax treatment has several consequences. Expanded tax provisions. The entity will now be able to leverage certain provisions in the corporate tax law that are otherwise restricted to entities taxed at the general rates. For example, membership in a tax group. The entity can join a tax group, aligning its tax treatment with that of other entities in the group. Small business relief. Subject to meeting relevant requirements, the entity may also qualify for small business relief, offering potential reductions or adjustments in its tax obligations. 4 illustrative examples of compliance scenarios. Example 3. Excluded activity and non-qualifying status. Company, ELLC. Activities. ELLC operates as a free zone person and generates all its income from leasing property located outside of a free zone. Tax treatment. Since the revenue generated from leasing non-free zone property falls under excluded activities, it does not qualify as qualifying income. Outcome. As ELLC exclusively earns non-qualifying revenue, it fails to meet the de minimis requirement, allowing only minimal non-qualifying income. Therefore, ELLC will not be considered a qualifying free zone person and will be subject to the general corporate tax rates. Example 4. Qualifying income derived from free zone property sale. Companies, FLLC and GLLC, both free zone persons. Transaction details. FLLC, a qualifying free zone person, owns several warehouses within a free zone. During the tax period, FLLC sells one of these warehouses to GLLC. Tax treatment. Since the sale of property is between two free zone persons and involves commercial property located in a free zone, the income earned from the transaction qualifies as qualifying income. Outcome: provided all other requirements are met, the income from the sale is eligible for the 0% corporate tax rate, preserving FLLC's qualifying free zone person status. Example 5. Non-qualifying revenue and de minimis threshold breach. Company, HLLC, a free zone person engaged in vehicle sales to other free zone entities. Revenue details. Total revenue for the tax period, AED 80 million. Qualifying income, AED 75,500,000 from free zone transactions. Non-qualifying income, AED 4,500,000 from transactions with individuals, an excluded activity. Tax treatment: transactions with individuals fall under excluded activities, and the income from these sales represents non-qualifying revenue. The de minimis threshold in this instance is calculated as the lower of AED 5 million and 5% of total revenue, AED 4 million. Outcome: since HLLC's non-qualifying revenue, AED 4,500,000, exceeds the de minimis threshold, AED 4 million, HLLC will not meet the conditions to be a qualifying free zone person and will be taxed at the general corporate tax rate.